where we are at the moment. As long as I don't answer myself. Well, if I talk to myself long enough, somebody has to answer, right? Not actually a big talker to myself, other than when I lose something, and I sort of talk to the things I lost. Doesn't seem to help, though. All right, just about 1 o'clock, so we can start getting going with the exciting disclaimer part of the show. All right, that's it, and we'll get going. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trade. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides educational and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you can't afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletters. Rest assured we take your privacy very seriously, and we will not distribute or sell your information to anyone. Fini. Okay, cool. Now, we can get going. Welcome, everybody. This is going to be probably a not too long chat session. We'll do an hour, a little bit over an hour. And I'm going to share my desktop and we'll be all set. All right, hopefully the magic screen is changing. And you may be looking, I imagine, at the WebEx thing here. You should be able to see Thinkorswim now. I'm going to bring up my little chat box. Can you see it? Come on, Patrick, you can respond. I need somebody to talk to me. Great, thank you. All right. Yeah, this one's a private one, so we're not going to have as many people as we had last time, but we're going to discuss a lot of the some trading strategies and trades we like and so on and so forth. If you have questions, please feel free. This thing works best when people talk to me, okay? We did a little oil trading today. I can start with that since we have that chart up. Let's back this thing up. Basically what happened is in the morning, well, let's go there first. No, I did not want to start that screen. Bastard. View tab, go away. Okay. So in the morning, what time was it? Might have been earlier than this. Well, I'm getting that one, I'll get the other one. There you go, multitasking. So our early chat was, let's see where we were. Oh, I see, I remember, because Burton was asking me about what we were doing with oil, and I think I said nuts. Well, we were going long here. No, got to go back to the other one, sorry. If you ever want to trade these things, if you're up early in the morning, what we do is at the end of the previous day's chat, before I make my new post, this is where we start talking about oil and such. So let's see when we started. 6 a.m., 5 a.m., 3 a.m. Now, it doesn't mean you have to get up at 3 a.m. to play. It just means that, you know, I woke up at 3 a.m. I was actually up before that. I was posting. See these things I posted at 12 a.m.? I was up and down all night. But officially, I woke up at 3 a.m. Usually when I say good morning means I'm ready to do something. And oil was up to 50.40, but then plunged below 49.50, 49.40. Support looks like 48.85, but if that fails, 47.50. So that's my outlook in the morning. You know, I'm already looking at these lines for an hour. You know, usually I've been looking at the lines over the night. So what I said is that support looks like 48.85, but if that fails, 47.50. So at the time, that was 3 in the morning. So here we are at 3 in the morning, and I said support looks like 44.80. Well, what did I say? I think I said the wrong numbers. This isn't even the right week. That's weird. I'm like, how are those numbers so far? I sometimes make a mistake, but I don't make mistakes that big. For some reason, I pulled up the wrong Monday. We'll try that again. $6.40, $2.48. See? All right, so at $2.48. We were watching 44.50 on CL, and I said, time to bait another hook. So what I mean by that is what we're talking about when we do these trades is you're going to lose money. If you can't accept that fact, don't play the futures. You are going to lose money as often as you make money. The trick is to manage your money in such a way that you win more than you lose. And you do that by getting in good spots where you can take an easy stop out. Like that, you say, if this line fails, I'm not sticking in this trade. So you take a small loss, like $100, $200, and you're done. The idea is that if you're right half the time, sometimes you make 100, sometimes you lose 100, so that works out. But once in a while, accident, you catch a really good wave up and you make a lot of money. So when I say we're time to bait another hook, we're going to sit there and we're going to risk another $100 on a play with another contract at 44.50. This is at 2.48. So at 2.48. Here's 44.50. Here's 2.48. See that? So right about there, I said I thought it was time to check. We figured we might have support here. All right? But if not, 44 is an easy target. 44.50 would be down another 3.4% for the day. Amazing stop, blah, blah, blah. So where did we actually end up? We actually ended up a little bit ahead of 44. All right, so what comments developed? This is what I thought would happen, but just because you think something's going to happen, you don't stick to it. You observe and you see what's actually happening. All right, so my next comment at 6, people are expecting a big shot. Oil, okay, here at this point, see, after observing it between 3:30 and 6, or 3 and 6 o'clock, so for 3 hours of observing oil, what I decided is that 44.25 to 45 was a good range to play. All right, and so now let's take a look. Here's 44.25. Here's 45. That's pretty easy, right? Then right when I said it, right here at 44.25 at 6:20, and I made that comment at 6:02. So right here, when I make this comment, boom. That's a 75-cent move. That's $750. Then we get a pullback a little bit later, and it didn't pull back quite as much. And we know what our range is, so we can start getting back in. In fact, I think I said something about that line later. You know, and I just want you to understand this is all we do. We observe and look for a new trend, and then we get on the new trend. So and of course a lot of the stuff I'm answering comments and things like that, so I'm not going over everything. I'm just trying to get onto this stuff. Now, what what am I doing? I'm watching the trend lines. I'm observing where we have supports and resistance, not the lines on Thinkorswim. You can't go by those because those are just drawn by the computer. We observe a line at 44.25 that was getting some solid support. So that's where we made our entry. And then boom, you get a $750 move up. That's what I'm saying. You know, we lose 100 here because we picked this wrong, it didn't quite work out, and we lose 100 here maybe. But then here we get a $750 win. As long as you control your losses, that one winner does fantastic for you. Now next. All right, so that's all there is to that. And then we caught this one too. This was a nice one, and we caught a nice wave up here. So bottom line is I made what, 25.40. That's my day's profit, and I got busy, so I stopped playing basically. But you know that's the way you do it, and you string a few of these things together, and you make some nice money for the day. But you have to go in saying I plan on losing 100 here, 100 there, 100 there, and I hope to catch a nice $1,000 winner at some point. But you don't. You know, but you have to understand, when you lose 100, you should be thrilled to make 100 back, and then you're even. Okay, because sometimes you'll get lucky. Just if you keep playing, it's like a slot machine. If you keep playing, you'll eventually hit a jackpot, but you got to keep playing. And the only way you can keep playing in this game is to even out your wins and losses. And you know, and by the way, I got out early here. I got out before this big run up to 46 because I said in chat, I said, look, I'm busy. I don't have time to sit there and stare at this thing. So I'm just going to take, I had $2,500 bucks. I'm going to take it and put it in cash and be happy, right? I could have made another couple of $1,000 maybe if I left it, but I don't regret that because I'll play it tomorrow and I'll play it the next day and I'll play it the next day. You know, for me, the futures are just something I play whenever I have some free time. But that's what it should be. It should be like a fun diversion, but you have to practice to make it that way. You have to practice to say, oh, whenever if I need a couple of $1,000 bucks, I'll play the futures. That's like you have to practice for years to get to this point, though. It's not like something you're going to be able to do tomorrow. I just got to tell you some secret. You have to get used to looking at these charts. You have to get used to watching these lines. You have to get used to these boxes and understand what they mean. And in fact, even though I understand what they mean, I'll tell you, there's a huge block here earlier today, and I was worried that somebody was trying to sell like a ton of oil, but after observing it for a while, it was like 300 or something like that, and there was another one above it that was like 200. So I'm thinking, okay, there's two possibilities. I'm like, if they were anxious to sell, then they'd be pushing the price down because they'd be overwhelming the rest of the buys. I said, what they seem to be doing is sort of letting people pick it off. Every time they get to that level, it's picking it off and making the amount smaller. And I said, well, that's kind of good then, because that means that probably this is causing the resistance to the upside. And so when you have a big number here and it erodes, you see how fast that whole row got wiped out? So a lot of these orders are fake. They're always fake. There's tons of fake orders all the time. But when you see a big block in a certain spot, like here's 55, that's a little bit bigger than a normal block, probably going to run into a little bit of resistance there until that number wears down a bit. You know, sometimes you'll see a flash and they all disappear, and that's not because there was a sudden interest in buying. It's usually just because these numbers are all pretty much fake. And you'll find out they're fake when you try to buy one and the thing runs away from you like you're poison. All right, so now let's get back to a couple of questions. Okay. Can we go over the UCO play, the February 8th put and call? Maybe it's me, but I seem to be panicking with UCO at 750 and my put at 8, only 30 days out. Now, is that in their short-term portfolio? Let me see. UCO. No. You know, Patrick, can you please tell me where you think that play is? I don't think we were officially tracking that, or we don't seem to be anyway. I have in a $25,000 portfolio, I think. Well, that's the only place I think UCO ended up, and all we have there. Oh, I didn't make that adjustment. I'm sorry. All we ended up with in the $25,000 portfolio was the, where's Monday? Are we supposed to roll that? I didn't log that trade yet. UCO. Here it is. In the $25,000 portfolio, well, for whatever reason, we have the 12, I know, we can't sell puts in the $25,000 portfolio, that's why. So in the 25 KP, we had 10 UCO July 12 calls, and we rolled them to the 10 July 9s at 140. You have something different, and let's see if you responded to me here. No, you didn't. Okay. Wait. It was a top trade. Okay, well, I don't track every top trade. That's just something. But absolutely, this is how you use the system, though. You feel free to ask me, and I'm happy to help you. So, in the top trade idea, we like the UCO, and what happened is oil came down harder than we thought, and now UCO has a problem. But the idea was to get a free play, and I don't know what the net cost of that trade was, but conceptually, let's take a look at UCO. So, UCO came down really hard and fast, and the idea was that anything above 8 would be a profit, I believe, on that spread. And at 750, I wouldn't worry about this, though, because all we're really worried about here is whether oil goes down, but you have, 40 days until the February expiration. Now, UCO, I'll show you another point. This is something you need to get used to if you trade options. You have to understand that you're not 38 days. So these 8 puts, think about this. These $8 puts that you sold for whatever, it doesn't matter what you sold for, but let's say you sold for $1 and they're $1.30 now. You say you're worried about it, but you shouldn't be worried about it because first of all, it only matters if UCO goes down to 6, and then you're going to be down $1 or something like that. At 7, you break even. All right, you paid net. See, you have to understand. You paid. Let's say you bought these for $1 and you sold these for $1, right? So you paid 0 and you're in the $8 calls. That was the point of the trade. Now, if as long as UCO is over 8, the trade costs you 0. If UCO goes below 8 and say it's at 6, then it didn't really cost you $2. What it does cost you is you end up buying UCO for $8 and you're in the stock for 8. So you've lost $2 on the trade. Okay? But then you can turn around and sell the July 6, the $6 calls for $2 and the $6 puts for $1, and you get $3 back. And then what have you done? You've taken your net 8 basis and reduced it to 5. And you'll still get a profit if you called away. You don't want to look at a trade as being static. That's the main point. Even if you didn't want to accept the stock and do another trade, you could take this one that's first of all, you understand that 743, when you actually get to February, if they're still at 750, these short puts are only going to be 50 cents. They're not going to be $1. And then you take that 50 cents and you roll it. And currently, well, forget what 50 cents is, but 50 cents basically takes you to the $6 puts over here. Currently, at $1.25, you can pretty much roll to somewhere between the 6s and the 7s. You can roll these. So your real entry is after you do a roll and after you adjust it and so on and so forth. So as that trade goes, I wouldn't change it, though, because we expected USO to bottom. It's bottoming exactly where we thought it would be. We didn't think it would go much lower than $8 on UCO. And sorry about that. I should turn my phone off. All right. So we forgot to, we don't mind owning UCO. The point was we don't mind owning UCO at 8 as a long-term play. And why is that? So now let's take a look at UCO. Your fallback on this trade is to own UCO for a low price, and that's certainly what's going to happen. UCO with an ultra long on oil. UCO was $32, 3 months ago. If you own it, I don't care if it's at 6. I mean, if you own it at 8 and you wait a few months and oil even partially comes back, you're going to have a huge winner. All right, and I say this over and over and over again. You don't sell puts in a stock where you don't really want to own it. But that's what this play is about. This play is about owning UCO at 8, which at the time when we made it, which I guess, I'm sorry, I don't remember the date. Did you write that? It was a top trade, January 8th. Okay, so if we go back to January 8th, at the time, whoops, Oh, well, it hasn't even changed much from where it is. At the time, UCO was right about here, 750. So it just hasn't moved. All right, we were betting that at some point it was going to move, but it certainly has stopped going down. Even though oil's actually gotten worse, UCO hasn't gotten much worse, which is surprising. So anyway, so the bottom line is I'm not worried about this trade. It's too early to do something about it, but you have to define what you mean by panicking. Why would you be panicking? This should be a little fun trade that you take, and it's like the point is with gambling with oil will go higher, and if it doesn't go higher then, I would re-up this trade into July. But I think that within 40 days, you're going to see it move up in oil. It's going to let you cash this thing out for a profit. But you got to be patient. You can't expect it to work in, I mean, seriously, January 8th. I mean, this is like a week after the trade was entered. So, you know, it's unfortunately, it's a 50-day trade and you're on day 7. So at this point, no, I'm not worried about it because I think oil's bottoming out right where we thought it would bottom out. Also, any update on the new buy list? Yes, I wanted to go over the buy list today. I haven't made a new buy list yet. No, it's really not possible to be in too much cash right now. I don't like the way this market's trading at all. But I think we will have a new buy list up, but I haven't done it yet because I haven't really, you know, I haven't really found enough stocks where I thought I could make a new buy list. I could update the old buy list with a lot of the same stocks, but we'll see. Bike says, what do you think of Goodyear Tire down 7%? I like Goodyear. I mean, I always like Goodyear, and I think the auto sales is strong. I think he's still in a strong cycle for another year and a half. Yeah, I'd say year, 2 years is a strong cycle. But they've been in a strong cycle. This is a strong cycle. We had a nice rise in these guys. They really haven't performed as well. You know, the auto industry in general, this has been your strong cycle that you caught. And car sales were up and up and up. And Goodyear Tire has, you know, they get their market share and they do well. I'm not sure why they did that before. But for whatever reason they drop like this, I would want to see them drop again. I would really want to wait till earnings and see if they missed or something. And if you get a great entry, great. But if you get an entry, if your entry's up here, that's not very sexy considering 30 is going to be hard for them to cross over. They've already proven that. So 30 is going to be hard for them to cross over. And you have to realize we're having big auto sales now. We've had big auto sales last year and this year, great auto sales. So the problem is, how are they going to get greater? Like, we can't really sell more cars than we're selling now. You know, you might sell 1 million more cars, but that's not going to be that big of a deal for Goodyear because 1 million more cars out of, you know, 100 million that are sold is 101 million, 1%. Now, how many more people can you really shove into cars in a single year? And that then limits the potential growth. Coming off 11, you know, GT was one of the ones we loved back here when they were down at 10 because I was like, eventually people are going to buy cars. And if people don't buy cars, they're still going to need tires on the cars they have. That's good logic. But now that we've hit this car buying cycle, I don't see any real catalyst to the upside. That's the problem. But yeah, you're right. Low oil price is good for their input costs, so that's possible to give them a little bit of a bump. But and I don't think people are really going to start driving. I don't think people's habits are going to change that much. I think they've really OPEC. You know, well, it's not even so much OPEC. It's really the people who manipulate the energy markets here. But they've really destroyed demand. They've created a long-term destruction of demand. People's habits have changed. People don't do road trips like they used to. People don't. You know, and also the whole lifestyle. Like my kids are so different now. Like they'll see they visit their friends on the phone. You know, they do FaceTime when they want to visit their friends. They don't like go driving somewhere, especially with someone far away. You know, and they have friends who are far away, much more so than we used to when we were kids. But when they have friends far away, they just talk to them on chat. You know, they don't run in the car and go places and do road trips with their friends and so on and so forth. It's just not as much of a thing anymore. You know, we used to drive a lot. We used to love driving. We drove all the time. But I don't see kids today doing that kind of stuff. I think they more just drive around their neighborhoods and stuff. You know, families still go on trips and things like that, but it's just normal stuff. I don't think you're going to get any huge uptick in driving. I don't think you're going to get a huge change of habits. And people are still going to buy fuel-efficient cars. I mean, they just been burned too many times by oil prices just suddenly forget everything. Although it is scary how fast truck sales came back this year. Seriously, I like Goodyear, but I mean, they're not cheap. If they were 18, if they drop to 20, I would probably say, that's kind of fun. But if they, but at 18, 26, it's pretty much the top of their range at the moment. TF, what has TF done? Yeah, look at that. They gave up all their, now see, they gave up all their gains. They're dead. 0.21%. The S&P, 0.26%. I mean, this is terrible. Oh, look at the Dow still falling. Holy crap! This is why we didn't make any moves today in the chat room, because we, the run looked like bullshit, but it's hard to say when what's real and what's not these days. And apparently, it's all fading out already. But I said that in the Morning Post. I said that this is we're going to get the bounce, but what matters is whether it sticks or not. And unfortunately, it's just not sticking. If global growth is so great, why is FCX getting killed? Well, FCX is getting killed because copper is getting killed, but you see that. That's true. Global growth is not great. This is what I keep talking about. I mean, China is collapsing. Japan has collapsed and is on life support supplied by their central bank. Europe is a frickin' mess, and if they don't get the support that they expect in a week from Thursday, when the ECB has a meeting, if they don't get a huge amount of money, I mean, $600 billion is the minimum they expect. $600 billion must be thrown into the system, and that's the basis on where they're holding on to right now. If they don't get more than that, they're going to be disappointed. If they get $600 billion, they're going to be disappointed. They want to see something spectacular coming out of the ECB. And the reality is, though, the ECB is run by austerity people who are not likely to do that, who are not going to be sitting there throwing the money out the window. The Germans have this paranoid, psychotic fear of inflation based on something that happened to them in 1920. They just can't let it go. That's like if we still feared stocks because the market crashed in 1920 and the Americans wouldn't buy stocks. It's just not a realistic fear. But they're so terrified of inflation that they'll do irrational things with their monetary policy to avoid it. It's going to wreck the whole European Union if they don't get their act together. Let's see. Oh, we bought the call for 135 and sold the call for 85. That's what? No, you're confusing me. Well, one's the put, and one's not. I see you mean sell the put. All right, so that was net 50 cents. Well, I'm not happy about that because net 50 is not working out. But then, all right. Well, here, in case we don't talk about this next week. Well, obviously we should talk about it next week because you're going to be here. Now, when you have a spread and you paid net 50 for the spread, the point at which you want to act is before your long position drops below the net of the spread. So your net of the spread is 50. Right now, this is what, 75 cents. So you can still take 75 cents of value out of this spread. Ignore the short puts. Doesn't matter what they are because, again, it goes back to if you really want to own UCO for the long term, if you want to own UCO in July when it's probably going to be back at $16 or so, then what do you care if you get it signed at 8 or 6 or 5 or 4 or 3 right now? In fact, you get it signed at 4, you double down, then you'll have 2 times as much as 6. So who cares? So, and I would be thrilled to have a 2x position in UCO at $6 a share on the average. So that's not an issue. So to me, there's no issue to owning it on the downside. You can roll your position. You can do all sorts of things on the put side. But the bottom line is what you did is you paid 50 cents. So you want to salvage 50 cents out of the play. How do you salvage 50 cents out of the play? Well, you got 75 cents right now. You can take the 75 cents and you can roll it to where is it logical that oil is going to be up? Oil should be up in July. So you can roll it to, let's say these are 7s. So it's 75 cents for the 8s. You roll it to the July 7s, and they are $2.05. So that's what, $1.30. Okay, so you spend $1.30 on the roll, and then you sell the 10s for $1. So now what have you done? Now you have the 7-10 bull call spread in July for net 30 that you spent. You spent 50 to start with, so now you're in the $3 spread for 80, but you've dropped your basis down from 8 to 7, and you've given yourself, what, 130 more days for the play to work out. So you see how you make those adjustments? But the trick is you do need to do it before you lose your value on your calls. Right now your calls still have more value than you paid for the spread. So you can salvage that value, but you salvage it by making that investment. You spend $1.30 to make the roll. You now use your new position. So you spend $1.30 and you roll to here to the 7th, July. Then you get $1 back by selling these calls, and that puts you in the 7-10 spread. And you still got your puts, and you can roll your puts too eventually. In fact, right now you could roll your puts to the 6s in July. But I'm not saying you should do that because I think that by February you'll be over 8 and it'll expire worthless. Then you could sell more puts and lower your cost even further. All right? And I'm very happy. You can ask me about this thing every single week. I'm happy to go over it with you as we do these things because this is how you have to learn. You have to learn by running through these trades and doing it. But I will tell you that this is probably not a bad time to roll because even though it's a little premature as far as your action, the reality is if you want to get into this position, if you like the idea of having the July spread, now's a good time to do it because you run the risk of if oil does fall further, those puts will deteriorate pretty fast, and then you may not get as good of a roll cost-wise, especially because the ones you're going to sell are going to drop in value too. All right, so that's just an issue for your comfort zone. But what you really need to do if you're planning on holding on to it is just watch the spread. As long as you can do the roll for $1.30 or less, then you're good. In fact, if you're pretty sure you want to do the roll, but you're saying I don't know if I can get a better price, ask for a better price. Just put in the order for the roll for $1.20. Because then if you fill it, you'll be like, yay, I saved myself a dime. All right, if it doesn't fill, it doesn't fill. No big deal. And Christy says, why do I feel oil has bottomed out? You can't do this one every week. What's the short story on oil? The short story on oil is that there is oil that is produced for $20 a barrel. There's oil that is produced for $40 a barrel. There's oil that's produced for $60 a barrel. And there's oil that's produced for $80 a barrel all over the world. 90 million barrels a day produced at various prices. The blended average of the oil produced in the world is roughly $70. That's an average cost of pulling oil out of the ground on the planet Earth. Now, it is possible that when you first of all, it's hedging. So as oil goes down in price, there's a certain amount of time at which people have hedges where they pre-sold their oil at a certain price. So even though oil says $45 a barrel right now, what's happening is a lot of oil producers are still selling oil for $100 a barrel because they have contracts. They play the futures market too, and they've sold their oil. They've advanced sold their production at a certain price, and maybe they've gone 6 months out, maybe they've gone 3 months out, maybe they've gone a year out. Not too many people go a year out, but they go out various amounts of time. So that hedging means that they can keep producing oil, and only the suckers who bet that oil was going to go up are taking a loss on these things. So that's one thing. So there's a couple of factors. There's factors of how long it takes these unprofitable wells. So that within all these wells, there's a mix, and some are profitable and some are not profitable. And so there's a certain amount of time at which unprofitable wells begin to go offline. There's a certain amount of time at which the hedges run out. And there's a certain amount of time at which certain other production is brought offline or slowed down. Because basically, look, if you've got a gold mine, and it's easy, let's go to oil. It doesn't matter if it's oil or a gold mine. But let's say it's a gold mine. For me, it's easier to picture a gold mine. If you've got a gold mine, you've got a hole in the side of your hill where you live, and you pay people to get the gold out of the ground and sell it every day. Okay? So if you're paying people and your net cost of paying people and digging up the gold and doing all the things you have to do to separate the gold from the rocks and all that, let's say that costs you $1,100 an ounce, right? So you have these workers, you have these machines, you've leased the land, you got all this stuff. So you're spending $1,100 an ounce. Now, if gold drops to $1,000 an ounce, You're going to lose $100 every ounce you sell. Still costs you $1,100 to pull it out of the ground, but you're going to lose $100. Okay, but for various reasons, you may be willing to lose $100 because, like, if you ran a business, I know, I'm sure most of you guys run some kind of business. If you run a business, you know you don't fire all your employees as soon as you have a slow month. That's crazy. You got to rehire, retrain, blah, 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 all this. It's just not worth it. Same thing with having a mine or an oil field or anything else. You're not going to immediately turn around and shut everything down. That's crazy. So you're going to run at a loss for a certain amount of time, but at a certain point, you got to say, I'm not making money. And then you got to start laying people off and cutting back. There's no difference. The oil business is just like any other business. Okay, they're going to run it. So in 1 month, when you have this incredibly steep decline in 1 month, anybody can survive a month pretty much. And that's all it's been. It's only been about a month of oil dropping like this. But 2 months, 3 months, no. By 3 months, and it's the same thing. Just imagine you have a candy store. Doesn't matter what it is. You have a candy store, and no one's buying candy. And all your candy's going rotten. Like, you know, you got chocolates, and all your chocolates are going bad because you have to sell them in like 30 days. Otherwise, they go bad. Now you got some serious problems, right? So what are you going to do? First of all, you're going to clear out your inventory. So you're going to sell whatever you can for whatever price you can get because you got to get rid of your inventory. But you're not going to make more if no customers are coming in. You're going to start shutting down your factory and laying off your workers. And that takes supply off the market. And then you know what happens? All the people who used to go to your candy store have to go to somebody else's candy store. They go to your candy store and you're closed because you couldn't afford to keep it open for at those prices. Then they have to go to your competitor. Then all of a sudden your competitor sells out. So your competitor goes, gee, I sold out. I guess I can raise my prices because now there's not a glut of candy on the market. That's how fast things change. But when I say fast, everybody has this illusion this is going to happen tomorrow. It doesn't happen tomorrow. It takes a month, a week, 2 weeks, 3 months. You know, you have to have the idea of what goes on. And you have to think of it as like, if you've been in a business and slowed down, how long does it really take before they start cutting back? And how long does it take for them to cut back and slow down and so on and so forth? And then how long does that take before the customers have a problem with it? All this stuff takes time, but it does happen. And a sharp price reduction like this is going to happen pretty quickly. All right, so that's why oil's bottomed out. Oil bottomed out already. Oil bottomed out at 55, but the momentum took it lower. But 55 is the bottom for oil, and you'll see that when we get back to a normal channel, that's going to be probably the bottom of the channel. Yes, and Patrick says inexperienced. Yes, I mean, believe me, it's all a panic when you don't know what's going to happen. You have to go through the process, but also you got to keep your portions under control. No trade ever should be more than like 5% of your portfolio under any circumstances. Like your max loss, 5%. No trade ever. That's thing number one. Thing number two is you do have to go through the process, and you have to understand it's a learning process, and almost everybody who learns how to trade loses money learning how to trade. It's unfortunately. Now, you can't play with paper trading accounts and things like that and do it better. But when you're going to do these kind of trades, you have to learn how to roll and how to play it over time, and you have to realize that your trade is like it's a continuing experience. It's not the one point in time. You have to just manage it over time. That's really the trick. And once you learn that, you get so much more relaxed about it. It's like, oh, well, this quarter didn't work out. We'll get the next quarter. And Rich says, oh, don't chat privately, please. Please chat to all participants so it doesn't look like I'm talking to myself. Rich says, can you spend time going over the portfolio since there are a number of moves to make before the end of the week? Okay, shit. No, I'm gonna email those out. I'm not gonna go over the portfolio today. We're never gonna get to anything. Tomorrow, actually, we'll be sending out an email for the butterfly portfolios. And of course, it'll be in the chat room. So I think you're mostly talking about the butterfly portfolio. That has a lot of mandatory moves that have to be made. But we're going to go over that in detail tomorrow. I couldn't possibly take the time I would need to do it today. Jal says, so what happens if they do get the stimulus, we go up or the money goes to Europe? I think that basically whatever, as long as it's over $500 billion, I think that will get a boost, but I think if it's around $500 billion, it'll be a very short boost and we'll go back down. I think if it's like $1 trillion, Like the Fed was, over $1 trillion. I think if we're at $1 trillion, then that should probably get us to new highs on the market. But either way, though, it's just more stimulus bullshit. It's just pumping adrenaline into a coma patient. It's like, yeah, they'll jump out of bed, but then they're back in the coma as soon as it wears off. It's not, I don't see, it's not fixing anything. The only way things are going to get fixed is if we actually do infrastructure spending and put people to work and put money in the hands directly of consumers by giving more of them jobs and giving better wages to them and dropping money back in the communities. Sending money to the Waltons in wherever the hell they are in Arkansas. Sending money to Arkansas by buying goods here at home, all that does is take money out of your community and send it to one of the top 1% people. That doesn't help the economy at all. You go to a Walmart, and what you're doing is you're taking goods from China that are sold by minimum wage people in America who can barely afford to live, and more than half of Walmart workers are on some kind of subsidies anyway. They're on like food stamps and stuff. So you're going to a minimum wage worker in America to sell you goods from China, and all the profits are taken out of the community. So the money that you made in your community is handed over to Walmart. They don't spend it in your community. They buy nothing in your community other than the minimum wages they pay to people. Other than that, though, all the money leaves your community and goes to Arkansas. What good does that do you? Does you no good at all? Does your community no good at all? It's a negative on the economy. It's not even a positive on the economy. And that's why these retail numbers are so misleading, because when you see these retail numbers, you say, where is this money going? Retail sales used to drive this economy in the days when retail sales meant when you went down the street to your local hardware guy and bought a hammer that he bought from the local hammer factory, like that kind of stuff. That used to put money into the economy, because the hardware guy would make money. The hardware guy had a shelf stocking guy that made money. The landlord for the hardware store made money. The hammer people made money. They employed people in your area too, not necessarily your town, but they employed somebody in your area too. The truck delivery guys made money. There are these people. Some of them are still in the chain, but the bigger and badder these giant chain stores get, the more the money just gets sucked out of your community and it never comes back. So you work so hard to create $1 of wealth in your community, and then you hand it over to these chain stores, and they take it right away from your community and send it as far away as possible. Does you no good whatsoever. All right, so that's a real problem with money and things like that. And people have very big misconceptions because all these old economists, and these are guys my age, but they have different attitudes. But these older economists and stuff, they generally look at the world. They think the world is the same as it was when they took Echo 101. They don't understand how it's changed. Things just aren't like that anymore. You can't give the same kind of weighting that you used to give to these things. And Zhao says the market futures going down, oil is going down too. Please explain. Well, what do you mean? There's no demand. That's exactly what they're saying. Actually, there's no actual demand. We haven't improved the actual economy. You haven't created a vibrant consumer class. So anything that you need massive amounts of people to buy, like oil, is going to have low demand because you've broken the backs of the consumers. They just don't have a lot of money. Now, the top 10% are doing great because people in the top 10%, like people in the top 1% have a lot of money, and then we trickle down the money to the top 10%, like the people who service us. So we then give them money, and so basically the whole top 10% is doing pretty good, but the top 1% is doing spectacularly well. Okay, and the top 1% outspends the bottom 90%. We spend more than those people do. So when we're doing well, we go out and spend, and has a lot of consumer spending. But again, it doesn't help the community. It doesn't grow the base. But that's okay because it doesn't matter to all these high-end products and stuff that are doing so well, and high-end retail, they're doing fantastically. They don't care, right? That doesn't matter. But the problem is, I spend a lot at a retail store because I will buy a $1,500 iPad or whatever, whatever they cost. So I'll buy the top of the line iPad. I'll buy the headphones that go with the iPad. I'll buy the charging thing. I'll buy the whatever. So I walk out of the Apple store, spend $2,000, whereas the average family for Christmas spends like $300. Okay, the average family in America spends $300 on Christmas gifts, and I'm buying a $2,000 iPad for one gift. So that's a big difference. But you know what the problem is? That one iPad only employs one guy making one iPad, so on and so forth, right? There's a limited amount of people I'm employing by buying my iPad. Whereas if I were a normal consumer, I would buy a lot of little items, but they take more labor, they're usually more labor intensive and so on and so forth. So I'm not really employing, as much as they call us job creators, I'm not really creating more jobs than the efficiency of the money at the bottom of the economy. And that's the problem. We're just not creating the right kind of jobs. We're not building infrastructure. That's the other thing. By not building infrastructure, we're not doing anything. The money doesn't last. In other words, if you hand money out to rich people and we blow it on electronics and things like that, or we take vacations, it's just burning money. We don't leave anything of value behind. Okay, the iPad is going to be worthless in 2 years. It's going to be scrap. You're not, the way to build something is to spend money on roads and bridges and high-speed internets and whatever, things that are going to have value for 20, 30 years down the road. That money that you invest now will continue to have benefits to people, far, far-reaching benefits that go down the line. Even building a new train station, a new bus terminal, and adding transport hubs and building rail lines, that just employs people and creates commerce and does all sorts of things. That's useful spending of money. Handing money to rich people by giving me like a cheap 1% loan or a 3% loan so I can buy another freaking house that's going to sit empty, that doesn't do anything for the economy, really. Okay, you give that same amount of money you give the same $500,000 to the house and give it to like, give like $5,000 each to 100 poor people, and they're going to spend that money right away in the community. The money's going to recirculate around right away into the community unless they go to Walmart. And it creates jobs, and then somebody else has the money, and they go and spend it and respend it. It's like a really good money multiplier when you give money to poor people and you do stuff with it. Or if you take that money instead of handing out 1% loans to me, you did a project in the town where you did a bridge, and the other thing they need to do is source these things locally to say, look, we're going to do this bridge project, but it's got to be made with U.S. steel, and you have to buy U.S. equipment to make it, and so on and so forth. Those should be specified in these projects. That's how you create jobs. Nobody's doing that. Nobody's doing it here. The only country that's actually doing it at all is China, but they're messing it up anyway. They're building cities that are empty for no reason. They're taking it to the wrong extreme. But this country, we have $2 trillion worth of infrastructure spending that needs to be done, and no one's doing it. So instead what's happening is that roads and bridges and electrical systems are all falling apart. And that down the road is detrimental to growth. It's insane. All right, anyway. So why the future is going down? Because of that. Because we're stupid. And they're also going down because they shouldn't have gone up. It was just that there was nothing positive that made these things go up. There was no reason for it. So it was just a head fake. That's all it was. And now we're back on course, which is basically what I said was going to happen this morning in the Morning Post. All right. When was the last time Draghi? I know Draghi talks and never really delivers. It'll be token QE, more words. Yeah, I mean, it's just, unfortunately, he talks about it all the time. I don't know if there's any particular news. I didn't see any particular news that caused this to happen, but it happened while we were starting this session. The second leg down here started right in the start of the session. But like I said, I didn't see any news that made it go up, so why should there be news that makes it go down? There's nothing. There's no reason for it to be up this morning, no reason for it to be down. And Mike says, it's called a fade. You run the futures up, get retail to buy while institutions sell. Yeah, that's been the standard pattern that I was complaining about all fall. You're right. The JPM butterfly adjustment that I posted in chat was the official move because it's a perfectly useful move, so we jumped the gun on that. But yeah, you can do it today, you can do it tomorrow, but that's generally the smartest way to play it. Oil's dropping back, really? Huh. Yeah, okay. Well, at 45, it's a good buy here. We're seeing this channel build up, so 45.25 is a good buy point. But with everything else crashing, it's not a good time to buy it. We got a nice run on natural gas. So look at this. There's that 2825 buy point right here. See that? Look how easy this is. 2825. Talked about this all last week. 2825, 2825, up to 290, up to 290, and up to 290. That's $750 every time it does that. Boom. That wants to be on my Christmas list. Not everyone gets an iPad. Some people only get iPhone. No, JPM was official because I put it in blue. So I mean, it was official. It was just a good move, and I said, well, I'm not gonna change my mind about it, but it doesn't have to be made today. Mike says infrastructure is just silly talk. I think we should invest in higher education. Yeah, right. And become universally available. Yeah. Oh, and that's the funniest thing. It's not really funny. It's sad. Obama's talking about like making a community college available to everybody. Right? Everybody gets free community college. And the freaking conservatives on TV, on Fox and crap, are talking about the cost, and the cost is $60 billion. But it's $60 billion over 10 years on a 10-year program. So the cost for the next 10 years of making sure every single person who can pass a test is able to go to community college and get 2 years of learning is $6 billion a year. We pissed that away on a boat. we spent $6 billion on one freaking aircraft carrier. And they're talking about $6 billion to educate every single person in America with a community college education. I'm disgusted beyond words about that one. I can't even believe that's up for debate. But of course, it's not only up for debate, but the chance of getting it to work is incredible. All right, and BLO, yeah. I didn't expect BLO to stay high. I don't see how they can stay high. How could their spreads be the same? When gasoline is $3.50 or let's say $3 a gallon, and now it's $1.80 a gallon, how could they possibly have the same spread? It's not even conceivable they could be making the same amount of money. And again, it goes back to the same question: how long will this stuff last? But when you see gasoline down here, see at 124. That's not good. That cannot be good for Valero. So I'm really surprised they haven't dropped much harder than they have now. All right. Anyway, so now's a good time to get to talking about the buy list. So let's do that. All right. So the buy list, we will do an update on this. I hope I don't know if I can't make any promises of getting this done this week. I wish I could. I'm going, wait, I got to go to California this weekend. So it's going to be tricky. Oh, and it's Martin Luther King Day Monday. We're going to have off, you know. Let's see. Buy list. Oh, here's our Secret Santa hedges. These are fantastic plays for this year. I hope you guys have looked at these. Secret Santa's inflation hedges. October review. Blah. Buy list. Yeah, here we go. All right. So last time we updated this was September, which isn't so long ago. And I love these dynamic calendars. They're really great because actually you can see exactly what things are doing, even though I haven't updated the actual article yet. So ABX, we liked them in May, and 1590 in May. Now it's 1074. Okay, so this is, you know, when you're looking at the buy list, this is the purpose of the buy list. It's to find things that have gone on sale. And I think last week we talked about ABX, right? So I'm not going to do it again. But we talked about ABX. I love ABX. It's gold. It's a fantastic, in fact, it's in my inflation fighter thing too. It's gold. It's an inflation hedge. It's a long-term investment. You know, you're not buying gold. You're buying a guy who produces gold. It's not quite the same thing. And they've been so discounted and so beaten down for no particular good reason. And you just have to give them time to prove themselves out. But this is a good, solid miner. We went over the numbers last week, and I really love this play. Obviously, the play would be different. I haven't updated these numbers. But look, here, you know, even the one we suggested, the 1522 bull call spread, that's way up here now, 1522 bull call spread. And that was, what, for $2. I bet it's like $1 now or something like that. So let's take a look, though. ABX. I want to give you an idea because it's, you know, this is, I mean, here's a seriously one that went very much against you. 2016, 1522 gold call spread. So 2016. See, the 15s are still 70 cents, 75 cents. So I don't care what the 20s are. And the 20s are a quarter, but it doesn't matter because they're so far out of the money, it's not going to matter. But what you do to salvage it, and it should have been done sooner, obviously, if you had the play, but you do the same thing we were just talking about. You take the 75 cents here, you move it to, what was that, the 15? You move it to like the 10-15 spread. So here's the 10s are like $3, and the 15s are $1.50. So this is $1.50. So 75 more cents, you're going to move to a $5 spread that's right on the money again. You see how easy that is? And now, see, in the original spread, I don't think we sold puts. No, wait, talk about short puts expire worthless. Oh, I see. I mentioned it up here. So the 2016, 15 puts. So let's say you sold those puts, so that wasn't in the in that part. But if you sold these $15 puts, the $15 puts are $5. But all you have to do here is spend $1 and roll to these 13 puts. So you basically roll down $2 for $1. All right. So you spend $1 there. And don't forget, the net of this trade was 0. So now what you've done is you spent $1 to roll to the 13 puts. You spent 75 cents to here. So you're at net 175, and you're in the $5 spread. That's after the thing went down 33% on you. You can make that adjustment. It takes it's really, these are very, very durable spreads. They take a fantastic hit, and you can still make adjustments on them. That's what I love about them. And they're not all going to work out right away, but frankly, the ones that don't work out are the ones you might want to consider like adding more to, because there's nothing wrong with ABX. They just hit a bad cycle. All right, and we want to, and by the way, I mean, you know, let's be realistic about this thing. Here's another thing you do need to do when you're doing these trades. This one was from what, May, right? So here we are in May. It did go down, then it went up, then it went down. So it's not like you don't have ample opportunities to stop out of these things. You shouldn't ride everything down to oblivion. You know, at some point you can employ a stop, especially on the short put side. And you need to say to yourself, it's like when you have a bad episode, once you get over the 50-day moving average, as soon as you're even, you should be so freaking thrilled that you're even that you're dying to get out of the trade. Because obviously our original premise was wrong. Our premise in May, well, where's May? Here's May. Oh, I'm sorry, this is where we bought it on this downtick. So our premise worked out, but then once it works out and then you blow the 50, well, I'm sorry, the 200-day moving average. Once you blow the 200-day moving average, you got to question that premise. You know, we don't go over these stocks all the time. This is just a list of stocks we like to buy when they're cheap. We don't track them every single day, but you got to use your head and have stops. AGNC we love, and they're still holding up very nicely, so they're not cheap, but they're great. ACAM, another one that's still expensive, unfortunately. It hasn't gone down. Broadcom, another one that won, so you can't do anything about that. BTU, now, I don't like BTU. BTU is going to come off the list, and the reason BTU is coming off the list is because of all these laws with the coal and the carbon and blah, blah, blah. So I am no longer interested in those guys. Cake totally got away from us. CCJ, though, now uranium's not going anywhere because uranium doesn't pollute. Uranium is actually a solution to the carbon problem, not the problem itself. So CCJ, I like this trade. And where do we start? They were 19.21 when we started. Now they're down at 15. And what we're waiting for here is for Japan to restart their reactors and start using uranium again. And then it's going to take a while to deplete the surplus. But eventually, over time, that'll work out. Now, I'm not saying don't do these trades, obviously. These trades are from, like, this trade's from 6-7. So I'm not saying do the 6-7 trade. But, and again, it's the same thing. See how it went down? And if you did accumulate as it went down, you could have gotten out with a much better price when it went up. But if you just sit here like a deer in headlights while it goes down and then back up to even and then back down and then back up and then down, you know, of course you're going to lose money when you stop out. When you finally give up, you're going to lose money. CHK, you know, long term they'll come back, but this is a tricky play with natural gas being in the dumper like this. I wouldn't run into this right now, but I do like them long term. CIM is an evergreen one. We always like them, and here they are at their normal price. CLF, perennial disaster for us. It just is not working out. But I said 985, and it's an 8 now. I'm not too upset about that. It's a long-term trade. Now 2017s are out. Same thing. So 13 puts. It's down at $8. We're going to roll the puts and make a new play. That's all. And that's the thing, by the way. You know, you're playing this position to make 700% on cash. So if this one doesn't work out, but the next one works out, and I make 700% on the next one, we're still going to make money. And if that one doesn't work out and we lose money, because you can only lose 100%, or maybe you can lose 200% if you're not stopping out or doing anything right. But you can only really lose 100%. Logically in a trade. I mean, you shouldn't. If you're losing more than 100%, you should be doing something about that trade. So if you have a trade with an upside of 700%, then you could lose 100% 6 times and make money on the 7th one, and you're still going to do okay. Can you show the map on how you? Well, that's a pretty vague question, Chrissy. So I don't know if I can show you that. Wait, somebody before you asked the question also. Pat said with a pop in NG today to someone. No. Wait, with NG. You mean natural gas? Wait, I'm blanking on this. I don't know anything about a 15-20 bull call spread on natural gas. You mean UNG? Is that the right price for UNG? Oh, that should work. UNG. Oh yeah, that must be it. No, I mean that's our target for 2017. I'm not. And you call that a pop? Look at the big picture on that thing. No, I like UNG to be back around 20 by 2017, but I wouldn't start messing around with it too much. It's just too ugly if you start playing with it. Buy list. All right, so see, DBA, I just put on my Secret Santa's inflation hedges. I love these guys at this price. eBay, too expensive, unfortunately now. Ed, too expensive. I mean, look, you know, it's funny how many of these have totally worked out. Exelon also, zoomed up. FCX, disaster, but a long-term play. Eventually, we will use copper again. Let's see. 700% gain on cash. It's the amount of cash you put in versus how much you make if it pays off. That's all. And that was UNG, yes. NOY failed, 200-day moving average plunged more today. How come when other REITs like EQR? Because they got downgraded. They were considered fully valued. That's all. Somebody put out a note saying these REITs are fully valued, these REITs are better, and people shifted their money from one side to the other. And so what? That's why we sell calls, right? We expect, you know it's going to happen eventually. It's just another opportunity to get in there if you're not in it. If you are in it, it's fine. All right. GSK, wow, they were great, and they went way down from being great, but that's okay. You know, I got to try to remember to put the prices in when we start, because I never remember where we started. 47 calls. We sold the 47 calls. Oh, I see. Oh, 48.62, sold the 47 calls, bought the 43. Oh, we net 40. Okay, so there we go. We net 42.52, which is right where we bottomed out, so that was a good call. So we're at 42.52, but it's for 2007, 2016. So it's nothing to worry about, and this is the way we work in a position. I got to show you this. All right. So our net on this trade is 42.52, and we sold the 47 calls and the 43 puts, right, for GSK. I just want you to understand how this works. GSK. I don't actually give a crap what the stock price is. What I care about is I sold, if this thing ever resolves itself. Ah, great. Now I'm not getting the numbers. All right, there we go. Boy. Now I forgot. It was the 47 calls, 43 puts. Okay, so all that matters is that we sold the 47 calls and we sold the 43 puts. Well, they're at 43, so I don't really give a crap about the 43 puts. But the point is my net basis there was 42 something, right? So 42.50, whatever it was. But what do I look ahead to? All I know is I take these 47 puts, 47 calls that I sold. Now we can sell these calls, the 45 calls, for $2.30, $2.50. These are $1.50, so I can get another $1. I'm not saying do it now because obviously they're going to expire over time. But I can already see where I get another $1 here. And I take these 43 calls, and let's say I roll into the 42 calls. They're like 5 something, 5.50, and these are $4, so another $1.50. So by just doing that roll, we're going to lower the basis by another $2.50 in a year. And you have to understand that's fine. Because all we did was we put down $42.50 for the stock, which, by the way, pays a dividend, so that's beside the point. But we put down $42.50 in cash for the stock. It went down, but we're protected. We already protected ourselves for it going down. And now next year we're going to knock another 5% or 10% off the price. So if I do that 10 years in a row and every year I knock 5 to 10% off the price, I'm going to end up with a really, really cheap stock. I don't care whether the stock actually goes up every year. As long as it stays in my range, I'm going to turn it into a good thing over time. But the thing is to be patient and to let the system work for you, not just to get fed up because, oh, this year it didn't make money. All right? So, you look at something like this GSK, and you say, oh, look what happened. It went down and down and down. We came in at 47 and went down to 43. Yeah, it went down to 43, but we're still fine. That's what's important about this system. That you can take that kind of damage. You can take a stock that goes down like that. And what do we care? Why is the stock on the buy list? The stock is on the buy list because we definitely want to own it long term. Not because it's the hottest stock in the market. It's because it's a safe stock that we feel very comfortable with. And there are very, very few of these things that burn us, very few. And mostly it's been the energy stocks and the commodity stocks this year. But even then, I think this is a great time to get it. Is the market getting worse? Holy crap. I'm so glad we stayed short. Wow. And I was almost regretting it, too. I was thinking this morning, too, when the Russell hit 1,200, I was thinking that I'm like, oh, damn, I really think maybe we should take off those TZAs that we have, because we have a lot of TZAs in February that are very aggressive puts. So glad we didn't now. I almost thought about it, and I was like, no, I just don't like the way this rally looks. All right. So GLL, fine, they're right on track. Actually, this is a bear put spread, so we want them to be lower than they are now, not higher. But that's April, so we would have to make an adjustment there. It's the same kind of adjustment in the same way. Offset with a short 17 ADXs, that was not a good move. So that trade didn't work out well. HK, they've come down. Wow, look at them. Selling the $5 puts for $1.30 and get a $3.70 entry. That didn't work out at all. That's terrible. But again, this is the oil services. These stocks have been a disaster. It's not that I don't like them. It's just that we have to really think about them and look at them very carefully now if we want to get back into these trades. HMY, that's a fun one. Way down, way. Now, if you had stuck with it, you would be fine. But if you had actually gone and accumulated down here, you would be doing fantastically. You see, and that's the point too. It's to be able to, when you do these hedged entries, you have to do this kind of stuff. Hovnanian, we love them, and they're a little bit weak still, so they're still a good buy, and you can still get into that. Hewlett Packard, they got expensive. IBM, big buy. IBM is one of my top picks right now. I love them down here. I think they're holding up very impressively. We're going to get earnings. I kind of want to wait for earnings, but I really like these guys. IGT got away. That's done. iRobot, a stock of the stock of the century. iRobot's that stock of the century. They're still definitely in the buy zone. In fact, it was 33.15. They're still 33.15, so it's the exact same play basically. And I'm not saying make the exact same places. We're going to amend these to all be 2017s and whatever we can to stretch them out. ISRG, flying, too late for them. 364, holy crap. Forget it. It's 522 now. JDSU, another one that flew away. KBH, what a crazy day they had today, huh? First they were up and now they're way down. But we still had KBH. All right. When do the February oil futures expire? February oil futures expire usually they're around the 20th. It's actually 3 business days before the 25th. So you got to figure out when the 25th is. It's Sunday. So it's going to be 1, 2, 3. It might be the 21st. I can never figure out what they mean by 3. But it might be the 21st. It might be the 20th. It's one of these 2 days. So about a week. What's now 40 cents? Oh, the spread. Yeah, the spread went crazy, huh? Lionsgate Film, I like these guys. The Hunger Games, the Mockingjay Part 1 thing was a big deal for them, and that didn't go quite as well as it should have. They got the Part 2 coming out. It's a good company. I like them just as a nice buy and hold sort of thing. Lulu went crazy, finally. I mean, you know, we kept thinking they were too cheap, and now, you know, obviously they were. Mattel is still sucking. We're going to get the numbers on Barbie and stuff and all their doll sales and whatever, so that'll be interesting this quarter. I like them down here. I think they're good solid long-term play. Where were they here? They were 34 something when we were liking them. We like the stock at 34.50, so they're at 28.50 now. They're down like 20%. All right, so that makes them a good buy. That's, you know, it's someone on the buy list when you see it's down 20%. Unless something really bad happened to them, that's good. Newmont Mining is an okay mine. We like them. I like ABX way better, though. NLY, as you can see, this is that bad. They got downgraded around here, and they fell down pretty quickly. It's a buying opportunity, though. Oh, and by the way, you guys know this. So when you see a stock dropping like this, what do you think? Sell puts, right? So do we have any good put entries for NLY? Because when the stock is dropping, the puts get more expensive. When the puts get more expensive, we collect more premium. So you look at 2017, they're at 10.60. You can sell the $10 puts for $1.70, or you can sell the $8 puts for 70 cents. Think about that. So let's check this out. If you do Thinkorswim, if we do sell these, what? Why are you showing me 45 cents? Oh, that's bullshit. So 72 cents. If they're 32 and they're $1.72, that makes sense at 72. So if we sell these, let's call it 70. So your net entry on that becomes what? $7.30. So I definitely want to own NLY for $7.30. Look at the margin on this. The margin is $4.95. So you get $700 in cash in exchange for $500 in margin. That's for selling 10. So that's a good deal, but I personally would be confident enough in these guys that I would sell the 10 puts. I wouldn't even bother with that step. I'd rather collect the extra buck and take the risk about selling the 10s, because that's just crazy. But anyway, so the point being, you can get a good price, right? See how but all these last sales have shot up to the top of this range, and the reason is because it's going down. If it was going up, you wouldn't get these prices. So this is the time you sell. And if you sell that for $1.72 and you buy the stock for $10.60, now your basis is 9, and it's going to be $9.50, right? Because you have to buy more at 10, so it's 9, and then it would be 19 and $9.50 for the average for 2 times. And then you sell these $10 calls for $1.40, and now you knock another, let's call it $1.50 off. So now you're down to $7.50 for net entry on NLY. You get called away at 10. And you may, if it's below 10, you'll be forced to buy another round for $10. So what? That's $17.50 divided by 2 is $8.75. So your net entry on the stock is $8.75. That's your worst case scenario. And meanwhile, you collect all those fat dividends on NLY. It's not a negative. You know, when something drops like that, it's like, yeah, how do I buy more? You don't look at that as a negative. It's like a fantastic opportunity. NTAP, we actually had those in the short-term portfolio. We actually got out of them after a while. Because we had, we had this nice big huge rally. We started at 520 with a really huge rally, and we said that's great, 43 bucks buy. Who else? New York Times. Carlos Slim just became the largest shareholder in the New York Times. I really don't like that. I hate it when these billionaires keep buying up the media. It doesn't make me not like the stock, but just kind of ticks off about the whole thing. Pfizer, boom. PNW, boom. RIG, total disaster. That one of my worst stocks of the year was RIG. RIG and Cliff, I think, are the two worst of the year. Oh, and of course, GTAT. 3 worst stocks of the year. RIG, I still like long term. I think this is a crazy low price. I think they're a good buy still. RRD, I never understand why anybody doesn't just buy them. It's a great company. Sears holding on very nicely and chugging along. I don't like them anymore, though. They changed too much. It's too complicated. I can't figure out what they own and what they don't own. I'm not sure where they're making their money. It makes it unattractive for us. So Taser being our stock of the decade, and since we're now officially halfway through the decade, it has finally decided to start looking like the stock of the decade and taking off for us. So we're happy about that. What economic climate is best to invest in? REITs, Chrissy says, the one we just went out of. After the housing market crashes, you find out which REITs survived and have money. Those REITs then gobble up all the cheap real estate, and then when the market starts coming back, they make a fortune. That's easy. Tex has been not good at all. They were 39.80. Wow, they've had a terrible time. They came flying down from there. This one I would have to look over very carefully before I decide to want to make another investment in this guy. I don't like the way they're looking. I mean, that's nasty. I don't know how bad their business could possibly have gone, but it's funny. So they'll never see the teams again. It looks like they might see the teams again. I thought we were going to have building and infrastructure. I can't believe that this country has gone and just completely ignored the concept of building and infrastructure. Just did not think that was going to happen. UBNT, we kind of all soured on. That's kind of off the list, I think, at this point. Wendy's obviously was too cheap and it went up. Whole Foods, of course, also too cheap and went up. So it's a mixed bag. We had a mixed bag on these things. The material stocks just completely killed us. But on the whole, it was a good list and it worked out for the most part. And the reason it works out, by the way, is the same thing. Is that if you diversify, the ones that work out make 200–300%. The ones that lose 20–30%. That's how it works. You don't need too many winners if your winners are going to make 10 times more than your losers. Buffett says everyone who eats hamburgers would be happy if the hamburger prices went down, would go down. However, the investors would not be happy. Stock prices would go down. Oh, I see. Even if they're long-term investors, that would investors think that stock prices is at loggerheads. Yeah, well, that is true. That's what I keep saying about that's like my Levi. When I keep talking about that Levi example, I'm like, you got to have a value to the stocks that you're buying. And when they get cheap, you've got to say, God, that's great. I can buy more. And this is, I think, the biggest problem investors have. You've got to learn to enter your positions. This is what we talk about scaling. Go to in our strategy section, we talk about scaling. There's a whole article on scaling in and out of positions. It's so important. You should never, ever, ever pick up any position where you don't fully intend to double down on the position if it drops 50%. That should be your plan going into the position. Because if you have a plan for what you're going to do when a position drops 50%, then you're going to learn how you make money as long as it doesn't drop 50%, and you're going to have way more winners than losers, because you're going to turn those losers into winners. Unless somebody goes bankrupt, and even with all this crap that we have this year with RIG and all that, the only one who went bankrupt is GTAT, and they're not even really bankrupt, but they're kind of bankrupt. The only one that we picked that actually had not in the buy list, but the one risky stock that we picked that went bankrupt was GTAT, and they're almost certainly not coming back. That's only one out of all the stocks we played this year that you can't recover from. The rest are just, we keep playing them. They're fine. And you see that in the long-term portfolio. It just keeps grinding out gains and grinding out gains and grinding out gains. Why? Because this system works over time. But you got to give it the time to work. And you can't be impatient. And impatient doesn't mean 3 months or 6 months. Impatient means years. You give it, these investments are 1 year, 2 year cycle investments, and you go through 3 cycles before you're really going to drop out of a stock. Unless something fundamentally changes. We throw out of this list, I have like 2 or 3, I think, that we said now we can get them off the list. And Sears is not off the list because it's bad. It went bad. Sears is off the list just because I no longer understand what the hell he's doing. When I understood what he's doing, I was comfortable with investing. Now I don't know what the hell he's diversified, where the money's coming from, who's got what. It's too many games. So I'm done. That's it. There's plenty of other stocks we can play with. The material stocks, the ones that are primarily the losers on this list, they're in the down cycle. That's why they're on the buy list, though. The point of the buy list is when these things get cheap, you want to buy them. It was arbitrary when we created the buy list in May. It was an arbitrary time to say, okay, let's make a list of stocks that we like. That wasn't the point. It wasn't a list of stocks that were at bargain saying if these stocks get cheaper, this is the kind of place we want to set up on them. So there's a few stocks here. There's stocks that are going to get eliminated from this list because they've taken off already, and we can't use them anymore. Taser, too high, even though I freaking love Taser. But it's not going to be on the buy list, I don't think, other than maybe a note to say if it gets cheap, we want it. Wendy's, no, it's like way up. Well, Whole Foods, gigantically up. When stocks have totally gone away from us, there's no point anymore. PNW is completely gone. We're not chasing these things. Pfizer, we might be able to grind out. I have to take a look at what the long-term options are. But you've always got to have a list. You've always got to have like 20 stocks that you're watching that you want to buy if they get cheap. And every earnings season, if you have a list of 20 guys, 5 of them are going to get cheap. And that's when you buy. But you have to learn that. I'm sorry, who said that about it? Jim. So what Jim was saying about Buffett is exactly right. I mean, it's the point. It's like you should want these stocks more when they get cheaper. You like them. The fact that they got cheaper shouldn't make you not want them. It's like when food goes on sale, like you said, or when pants go on sale or whatever. You don't go, oh, no, I'm going to eat that now. It's on sale. That's crazy. Yet that's how you act with your stocks. It's like, oh no, I like Transocean when it was 30, but I won't buy it at 16. It's like, what? That makes no sense, does it? And that's the problem. I mean, most of you guys pursue the exact wrong strategy for stocks. You like a stock, you think about buying it, and then when it takes off, you go, oh my God, I got to buy it. It took off. Oh, I'm going to miss out. No, you missed out. You did miss out. It's over. You've got to buy the ones that are cheap that you like and wait for them to come back. And by doing that, you don't invest in fly-by-night companies. RIG is not a fly-by-night company, Transocean. ABX is not a fly-by-night company. ABX has been around for 100 and something years. It's like 1890s or something they've been around since. It's an old gold mining company, and Transocean's been around for like 50 years. They've gone through economic cycles. They know what they're doing. ABX survived the Great Depression already. It's not like this is going to throw them off. And again, corporations, obviously, different guys and whatever, and you can be run by idiots, but generally it's a family business. When a family business has a history, when a business gets handed down and is in the family or is in a close-knit group for a long time, you do have that corporate culture, and they do act a certain way over certain times, and they do generally stick with the plan. And those are good companies to own because if they've been successful in the past, they tend to continue to be successful. And that's one of the fundamentals of change. The bad managers come in, different people, like Carly coming in and changing the culture at Hewlett Packard, things like that. Something screw up the company. And that's a big, major fundamental change. But when, a lot of these companies, they're on this list because they're so rock steady and because they're going to survive these catastrophes. They're the kind of stocks you want to buy when the chips are down. But then when you look at this list, and if your reaction to looking at this list is saying, oh, I got to get on that one because it's going up, that's the wrong attitude. The attitude is say, oh my God, look what a great deal RIG is. How do we do that? Boy, look at that. Our Warriors, see, this is the funny thing, because in September, when I updated this list, these blue things were updates from September. We started in at a certain price, and they went over 43. They were getting to 43. They never quite made it. But they were getting to 43. We were worried about them getting away this way in September. So they never made 43. That was my target. So they never made it to 43. But we were worried about them going this way in September. We weren't worried about them going this way. That's a whole different ballgame. Now they're down here, and everybody's worried about them going to 0. Instead of saying, wow, I'm so glad I can buy it up here. All right, so I'll be officially updating the list. My job is to go over these stocks, eliminate some, add some others, and mostly update all these trades up to 2017 for the new stuff. All right, last couple of questions and we got to go. Now a TBA person, we tried to go up and fail 50-day moving average. Well, okay, so we're talking about the, I imagine you meant said not a TA person. Whoa! That gets worse and worse, doesn't it? All right, well, I'm freaking thrilled. I love it. We're perfectly positioned for this, so I don't mind. John says infrastructure. That's the socialist now. Yeah, right. we don't want to leave anything behind. And you know what's funny though? We don't anymore because we don't take. In school, they don't learn any of this stuff. Like, my kids don't learn any of these things in school. I have to go teach them all this on my own, like a clandestine operation. But we used to worship the Roman culture and the Greek culture and all the great works that they left behind, and we marveled at the wonders that they created and so on and so forth. We don't do crap anymore. We just don't do that stuff. You know, these great civilizations were great because they built stuff. We don't build anything. We build apartment buildings. We build a couple of skyscrapers. This is no way to run a country or a culture for that matter. Yeah, like you say, it's America 2.0. It is scary. It really is very terrible. I'm very depressed. I'm sad about the way that we're running things here. It's going to be not a good thing. And the only thing cheap now is, and the funny thing is that energy, materials, and industrials are cheap. This is the ideal time to do a huge infrastructure program, to re-energize those industries and use those materials to build things that will last us. It's like so obvious and sensible and so on and so forth. Okay, well, Jim, so you're saying you wish it loaded up in March and April of 2009, but what is RIG? What is this? You don't think that's March and April of 2009? Oh, I shouldn't do that. What is it? This is a apocalyptic event for ocean drilling. Price of oil is so low, people think nobody's going to want these platforms again. Right? Because that makes sense, right? I mean, obviously, no one's ever going to try to take oil out of the ocean anymore, so this company's dead because oil is going to be $40 forever, and therefore these people have a worthless product. Even though they already are completely sold out through 2015 and like 80% sold out through 2016. They're pre-booked. It's not affecting their business. That's why you really want to get into RIG. If you want them, you should get in before earnings. They've already sold their 2015 inventory. They've already sold almost all of their 2016 inventory. People aren't not drilling. They're still drilling. They're just not making any money drilling. But RIG doesn't care if you make money drilling as long as you are drilling. And if at some point oil comes back in price over that period, well, that's a big bonus for them. So this is just the pricing on this stock is crazy. But this is what you had to look at in April of 2009. And by the way, I printed what day was it? I think it was last I don't remember. It was last week anyway. I think it might have been Tuesday or something like that. But I printed this, I posted up this thing of like what I did in 2009. On the actual day the market collapsed in 2009, when it really bottomed out, I think it was March 6th or something like that. The second to last day of the crash, when this thing we were down like 500 points that day. I just so happened to be live on TV while it was happening for 3 hours. And I was literally screaming into the TV. I'm like, buy this, buy that. Oh my God, look at that price, buy it. And you know what? Nobody did. I mean, some people did, but really only our members. There were so few people really would listen to what I was trying to tell them at that time. And to me, it's the most obvious thing in the world. But you know what? It's exactly as obvious as me telling you to go long on oil here at 45 bucks. It's exactly as obvious as me telling you to buy ABX and buy rig right now. That's how obvious it was to me in March of 2009. And you know what? You say you wish you would have done it, but you tell me 2 years from now if you did it. Because there they are right now, ABX, rig, and oil. You want to make a lot of money? Those are the plays to make. But they all look like shit right now, and they're scary to buy. And that's why there's an opportunity there, because so few people are going to do it. Yeah, well, you know, Mike's saying, like, oh, scary to buy Hertz. No, it wasn't. They're the biggest rental car company in the world. Are people going to stop renting cars just because the economy collapsed? They'll rent less, but it doesn't change their business. And they were, you know, and the auto companies, people are like, oh, they're going to get liquidated, blah, blah, blah. It's like, well, we're going to have no auto industry? That made no sense. GE was like, you know, $3 or some ridiculous price like that. It's like, what, GE is going to cease to exist after 100 and something years? All of a sudden, it's no good. It's like, it's crazy. Boeing went to like $40. It's like, well, who's going to make planes? Do we stop flying? We don't have a society that can stop flying. We're too spread out. We've already done it. It's too late. You can't put that genie back in the bottle. We need planes to get from place to place. It's part of our transportation system. Just because the economy sucks doesn't mean you can't fly. But it's hard. I know it's very, very hard when you're in the middle of a crisis. You can't see the end of it. But you've got to understand that you have to have a historical perspective on these things. And that's, by the way, it's a good thing to do. You should read these books. Read books on the Depression. Read books on the crashes. You have to realize who made money in these things. The guys in the Depression who made all the money were the ones who had their cash, and they went in there and they bought stuff like crazy while it was dying. Warren Buffett makes all his money because he buys when things are crashing. He doesn't tuck his tail between his legs and curl up in his living room. He's out there making deals. Remember, he ran in with $5 billion for Goldman Sachs and $5 billion from Bank of America. He bet the S&P, put a $5 billion bet. He lost $5 billion. Like, he threw $5 billion around the way we throw 500. He's got $5 billion. He made a bet that the S&P would be above 900. That was his bet. He got a $5 million bet the S&P would be above 900 in like 2017. So all you got to do is hold on for another 2 years, and he makes $5 billion on that bet too. It was basically a short put on the S&P. But at the time, the S&P was close to 900. So it sounded like, whoa, that could happen. All right. Last couple of questions I got to get out of here. All right. New Zealand, I don't know what the relevance of that is. Perry, you're heavy on energy. Okay, well, now is the time to be heavy on energy, but not way heavy on energy. You know, oil could go down further. If you're heavy on energy, you just need to have a downside energy hedge, like shorting Exxon or something like that. You know, if energy gets worse, Exxon's going to eventually collapse, and so will CVX. If it gets worse, or like Total, that's another good one. But you want to make sure that you've got some diversity, of course, and you want to make sure that you're hedged to the downside of what you're betting on. So if you have too much energy, you just need to make sure you have a specific energy hedge that's going to work, like short puts on long puts on Exxon or something like that. Like, let's take Exxon for example. So you have to imagine if we have a sustained drop in oil that's going to damage your other plays, right? Then Exxon is not going to hold $90. And let's say you pick up these are terrible prices. I mean, there's a lot of people obviously betting for this already. These are crappy prices. So when I see crappy prices, I say, ooh, how can I sell those crappy prices? So let's sell the 70 puts for $5, just estimating here, and buy the 85 puts. Now let's go up here, $15. So here's the 92.50s for like $13. And then you can go to the 75s. How much is that? That's 15, 17, wait, that's $17 away, am I right? 75 plus 15 is 90, 17.50, yeah. Okay, so the 75s are $6.50. The 92.50s are 12 or 13, let's say. So it's basically $6.50 for the 17.50 spread. So that spread's a little bit in the money already. And if Exxon collapses, you're going to make up to another $650. You're going to double your money. So you're going to make 100%. So you can hedge against a 20% loss in everything else by taking 20% of the money and putting it into this kind of spread. And then if things go up, your 80% should make much more than the 20% to cover the play on the way up. And of course, obviously, when you feel more comfortable that no damage is going to be done, you don't have to lose all this money. You can take the hedge off when you don't feel you need it anymore. But that's what I mean. You can have a hedge like that that's going to give you 100% return if Exxon fails to stay up. All Exxon has to do is dip a little bit and you make 100%. So therefore, you're protecting your other oil plays. Yeah, BHI, we like BHI a lot because of the fact that they've got a huge offer on the table and everybody's ignoring it. All right, last question goes to John Bose, who says, good question, Joe. Okay, I was leaving a question for me. Once the U.S. looks like 1990s Baltimore, they have to retreat and gated community. Yeah, it's not a pleasant-looking future. I hope it doesn't, I mean, look, I hope somebody smart comes in office and changes things and whatever, but I'm sorry, I just don't see anybody on the Republican side who's going to be doing that kind of stuff. Going along guns, well, we did that already. The gun thing's over, I think. I think the gun thing really had a big pop because everybody was scared Obama was going to take away their guns when he got in office. So everybody stocked up on guns. And I think that just killed it, though. I think everybody who wants a gun, all the kind of people who want guns have got guns at this point. And I don't think that's a very good trade. Not that you're serious about it, I'm just saying it's not a thing. That trade overextended also. So my big takeaways from this one, AVX and rig, Transocean, and oil at $45. It might go lower. All of them might go lower, but eventually we'll reconvene here 2 years from now, and we'll discuss what a brilliant idea it all was. Oh, look, they popped again. How nice. All right, so it's stabilizing here. So we're a little bit lower than we were on Friday, and we will see what happens. But thank you all for coming, and we will reconvene this next week. I'll be in California, so it'll be tricky, but I'll hopefully be able to do this pretty much the same time next week, all right? Take care, folks.